So now we know how to use CAPM, and we know it's a critical component of weighted average cost of capital, which is used in DCF stock valuation capital budgeting. But remember that CAPM, capital asset pricing model, the expected return it gives us, this is only a model. It's a representation of how we think the world works, built on certain assumptions, reasonable assumptions, but assumptions nevertheless. So the question, an important question here is CAPM a good model? Is it a good representation of how financial markets work? Can we rely on it? Is it a good idea to use that in WACC calculations and then to use that WACC in DCF stock valuation and capital budgeting? Right? So this is an empirical question, but it's an empirical question that's actually very difficult to answer, because remember our capital asset pricing model. Basically what it says is the expected return of a risky investment is the risk-free rate plus beta times expected market return minus the risk-free rate. So there are several issues in testing something like this. First of all, we do not observe expected returns. You cannot, for example, today think about, okay, let me look at Apple's expected return and see if it's a reasonable number. Let me compare it to CAPM expected return. We can't observe those expected returns. The best we can observe is actual past returns, only once they are realized. So we can use those past realized returns as some proxies for the expected return and compare CAPM expected with the actual realized returns. But that's not exactly what CAPM says, right? So that makes it difficult to actually test CAPM. Another problem is expected market return. I mean, who knows what that is? Now, again, we can rely on past market returns, but that's, again, is not perfect. Another problem is beta. We know how to compute beta, but that's backward looking, right? And betas of the companies can change over time. So that's also an approximation. So this is not an easy thing to do, right? But still, we can look at past returns and we can still ask ourselves whether, for example, looking at a stock, are the historical returns consistent with what CAPM says based on that company's calculated beta, estimated beta that stock should earn. So we can do that type of test or analysis. So what CAPM says in terms of observed returns, historical returns, is it says stock returns should on average be proportional to the stock's thematic risk. So basically, stocks or companies with higher betas should earn higher returns, and companies and stocks with lower betas should earn lower returns. Now, not always, not every stock, right? But on average, over long periods of time, higher beta should come with higher returns and lower beta should come with lower returns. That's a fundamental risk-return relationship in finance, all right? But here, the returns should be proportional to beta. So that's what exactly CAPM says. In addition to that, CAPM says, this is a very strong implication of CAPM, is that the only thing that should matter for a stock's return compared to another stock's return at the same time is beta. That's the only factor that should matter. Higher the beta, higher the return. There's no other factor, okay? So for example, importantly, stocks firm-specific risk, which is diversifiable, should not matter. That's a very important sort of prediction of CAPM, is this assumption that all investors are fully diversified. Therefore, the only thing that matters is beta, thematic risk. So firm-specific risk, however volatile the stock is, aside from its beta, it should not matter at all, okay? And finally, when we look at past returns, the relationship between the returns of, say, a stock and its beta should be linear, meaning that if the beta is 50% as large for one stock compared to another, its risk premium should also be 50% as large, right? So there should be a linear relationship between the reward you get from a risky investment and its beta. And that's also a pretty strong implication of the capital asset pricing model. So what do we observe in reality? Okay, so when we look at so what the literature academics have done is for a given point in time, for example, let's say you have these 500 stocks in the S&P 500. Split them into 10 different groups by sorting them by their beta. So compute their beta and then sort them from the lowest beta 50 to the highest beta 50. So there are 10 groups of 50 stocks. And then look at their returns, for example, past year returns or the past 10 years average return. What CAPM says is the 50 stocks with the lowest beta should have earned the lowest returns. And in that order, with each group with a higher beta should have earned a little bit greater return, and the group with the highest beta should have earned the highest return. Okay. Now there's going to be a lot of variation within that group, with some earning very high returns, some earning very low returns, but on average, the higher the beta, the higher the return. That's what CAPM says. So what do we observe in reality? When you do this analysis, here's what we observe. So beta is in the x-axis. Average historical annualized returns are on the y-axis. The boxes are each of those portfolios, each of those 10 portfolios from the lowest beta to the highest beta, okay, and their returns. Right? So each box says you see its beta on the x-axis and its return on the y-axis. And then the line is what CAPM says should be the relationship between returns and beta. So that's, remember the security market line from a few videos back. We had said all stocks according to CAPM should be on the security market line, and the slope of that is the market risk premium. That's that line. That's the security market line. So according to CAPM, if CAPM is valid, all stocks and portfolios and all risk assets should be exactly on that, and the slope of that is the market return, market risk premium, market return over the risk-free rate. Okay, so what we are seeing is actually that those boxes are not quite on that line, right? So there's something a little bit weird going on. So let's put together the evidence and let's talk about the evidence. So the good part in terms of the validity of CAPM as a model, so it's mixed, but the good part of it is, indeed, based on that empirical finding, returns are positively related to beta. The lowest beta stocks have their lower returns, and the highest beta stocks have higher returns. So that's good. That's what CAPM says should happen, right? So that's good. And also, not directly from this, but from additional empirical evidence, there's actually no extra return earned for bearing greater firm-specific, idiosyncratic, diversifiable risk. So that volatility, once you control for beta, once you take account of beta, the volatility or firm-specific volatility is not relevant, or it does not come with higher returns. So that's also good, right? Because that's a very important part of CAPM says returns should be primarily driven by, or only driven by, systematic risk, which is measured by beta, not firm-specific risk. So that's good as well. But not everything is great, right? So one thing we observe from that data is the relationship between observed returns, historical returns, and those companies' beta is too flat, meaning it's not steep enough. Now, the main takeaway from this is the most important thing is, yes, returns are positively related to beta, good, but not enough, not as much as CAPM says they should. Low beta stocks earn higher returns than what CAPM says they should earn, and high beta stocks actually earn lower returns than what CAPM says they should earn. So yes, positive relationship between returns and beta, but not enough. Okay. And one more thing that's sort of on the bad column, and in terms of the validity of CAPM, is CAPM says only beta should matter. For example, if you're comparing stocks and their returns, higher beta stocks should earn higher returns and nothing else should matter, right? But the literature, academic literature, research has documented a variety of other factors, characteristics that seem to explain returns aside from just a systematic risk as measured by beta. So for example, value is a commonly used factor. So remember when we talked about valuation multiples, we talked those with low valuation multiples for example, low PE ratios as value stocks and high PE ratios as growth stocks. So that value seems to be an important factor here. As mentioned before and as explained in the book, value stocks historically have earned higher returns than growth stocks. So that's an additional factor that is not in CAPM at all, right? So that's what we call, or what the literature calls, an anomaly, or at least if you believe in CAPM, it should not happen. So it's sort of like an anomaly from a CAPM perspective. Momentum is another factor. Stocks that have earned high returns in the near past tend to earn higher returns in the near future compared to stocks that earned poor returns in the near past. Okay, so that's a momentum. Stocks seem to have a momentum. Those that have high returns continue to have high returns in the near future. Okay, and that's another factor that should not exist according to CAPM. Investment is another one. Companies that invest a lot in capital expenditures and R&D actually earn lower returns compared to companies that don't invest as much. So again, doesn't exist in CAPM, shouldn't exist according to CAPM. And another major one is quality. Companies that are considered to have quality businesses, high profitability, low earnings volatility, so stable earnings, low debt, amounts of debt. So what you would consider a high quality, pretty stable business, earning large profits, pretty stable, not very highly indebted at all. These tend to earn higher returns than companies that are considered low quality, the opposite. And again, this should not happen according to CAPM. So these sort of factors, in addition to this beta as a factor, so these are all empirically driven. And academics have come up with other models than CAPM. These are called multi-factor models. Like if you hear 3-factor model, 5-factor model, and if you're a finance major, you will hear some of these in your future classes, finance classes. So as an alternative to CAPM, right? CAPM is a 1-factor model. The only factor is beta, systematic risk. So there are these 3-factor or 5-factor models that do a better job empirically explaining return difference across risky assets or stocks. So that's good. But the downside of these factor models is they don't have a theoretical justification. CAPM is a beautiful model with a very strong theoretical justification, as we discussed all along. These models are just empirically driven, and that's a weakness, right? So the theory, there's no clear theory behind them. And in terms of are these used? So these models do a bit of a better job empirically compared to CAPM because of that flat relationship we just talked about. But when you actually survey CFOs and when you survey investors, what do you use to estimate required returns and therefore cost of equity, this company's cost of equity? CAPM by far, despite its empirical failings, CAPM is by far still the most popular model. Now that may change going forward, but still, as of now, CAPM, capital asset pricing model, is the most popular model in estimating companies' cost of equity, which then goes into weighted average cost of capital and is used in DCF stock valuation, capital budgeting, and performance evaluation of risky investments.